Hey, everybody, welcome to Love and Reload, the voice of the relocation industry. I'm your host, Ben Cross, and I'm so blessed and honored to be here with my friend, Kat Weaver, founder of Power to Pitch. Kat has won 22 out of 23 fundraising pitches she's done. She now created a business around helping people get that money for their business because capital makes the world go round, and why not use other people's money? Kat, thank you for being here today.
I'm honored that you would have me.
This is so awesome because I know you do a lot of content. Your posts are incredible. If you don't follow Kat, you got to follow Kat. Her posts are incredible. They're vulnerable. They're what you need to hear. The do's, the don'ts, the tips, the tricks, red flags, green flags. We're going to get into all of it today as well. And I had the pleasure of actually meeting Kat through our EOA accelerator group here in Dallas, and gotten to know her a little bit that way. And I just know so many founders in our relocation space and my personal life as an entrepreneur who just need to find the courage and the way to articulate what they do in order to get the funding they need to realize their dreams. Kat, how did you even get in the comments, by the way, hit that like button, throw your questions in there as well. I see Jillian checking in. I want to know who you are, where you are in the world. Jill from Dallas is checking in here. But Kat, real quick, while people kind of come in, how did you even get into this business?
Totally by accident.
Okay.
So
all great businesses, right?
I say I'm a two-time accidental founder. First company was in college out of my dorm room. I did that for 6 years. That's the company that I won all those pitches for because I had no money, no network, nothing.
Yep.
And realized that was my secret superpower.
What was the business out of the dorm? Because I have a dorm room business too.
Oh, you do?
Yeah.
Awesome. Okay. So I wanted to actually go into medicine, but I had my stuff stolen out of my gym locker. So I created a wearable wrist wallet to fit ID, keys, cash, just small essentials. So I didn't want to wear a fanny pack. I was like, I want it on me. I ended up patenting a couple other wearable accessories like a neck gaiter headband.
Patents. Oh,
expensive.
I'm impressed. Expensive. Yeah.
Yeah. I'm so glad no one told me actually what would go into all of that. Otherwise, I would have.
Isn't that funny about business and starting a business? It's like if you knew how hard it was going to be, maybe you wouldn't try. But then you wouldn't have the benefit. I mean, it's like so many things in life because everything worth doing is hard. But if you knew how hard it was going to be, like I would have been deterred.
I'm glad I was naive because I wouldn't have taken some of the risks, or I would have been more deterred probably by mentors or opinions. I mean, we even see that a lot of the founders we help now, no matter whether they're raising, a $10,000 grant or a $10 million fundraising round, there's always someone going to tell them how to run the business or have an opinion.
Oh gosh.
So the really great founders take all of that with a grain of salt and do their own.
It's so bad that when we go to our entrepreneur group, it's like, okay, the first rule is you can't tell anybody what to do here. It's Gestalt. We have to say experience share. Here's what I did. Here's how I failed. Just saying, take it or leave it. Because everybody, when you start a business, everybody wants to tell you, your parents want to tell you to do it. Your friends want to tell you to do it. Everybody wants to save you from some fate that you're like hurtling towards.
Oh, my grandparents, every time I would call or see them, are you making any money?
Yeah.
And I'm like, I'm working on it.
Yeah, it's happening. I promise.
Yeah.
Get in the comments. I want to know who you are, where you are. Are you a founder? Do you have a business idea? Have you tried to raise money in the past? What questions do you have for Kat? We're going to get into the things that she looks for when she hears pitches from founders, things that work, things that don't work. I'm really intrigued by this. I don't want to be negative, but for me, the red flags are more interesting than the green flags. Okay. Yeah. I'm just saying. We got Jillian checking in. Hey, Kat, excited to have you in the office today. We got people checking in. Hit that like button. Adrian checking in from Gloma HQ. Excited to hear more about your story. Thank you, Adrian. We got people coming in over here. Oh, look at this, Kat. Yeah, this is awesome. Christine Hansen, very cool. Jackson checking in. What's up, Jackson? All right, can we just hop in? Oh, yeah, can I say my dorm story real quick?
Oh yeah, I gotta know.
Me and a friend of mine who was graduating, I was a senior. He had just graduated. He came back to Albany where I went to school. He actually lived under my bed. We raised my bed up, and he like had a cot underneath my bed. Totally. He actually is shout out to Jay Mizrahi. He's on Sirius Radio. He's published books. He's got a business again because as an entrepreneur, like you try, right? And so he lived under my bed, and he started this, and I was a co-partner in AlbanyExchange.com, which was a place where you could sell your textbooks, you could sell your used furniture at college, like kind of a Craigslist-y thing. And we also had like pictures from the club up there too, just to try to get traffic in. That was our thing. And we had interns. It was great. It was probably illegal. I don't know.
How long did it last?
It lasted like a year and change.
Hey, that's long.
Yeah. Yeah, it was cool. My dad's checking in. What's up, Dad? Dan from Tulsa. On the topic of timelines, what is an average timeline on profitability? I know all businesses are different, but is there an average? I love taking questions from the viewers out there. I'm going to ask you, what do you see about profitability?
Profitability is the most important thing now, I think, more than even growth and top line revenue, because the venture capital market has slowed down so much that they're looking at what point of profitability is in terms of what's an average timeline. There's no right answer. It depends. Are you a tech company, consumer product? The alcohol business is going to be different than a non-alcohol business. So you have to at least be able to have an educated conversation about what that looks like, what your math is, what is it looking like in 3 to 5 years from now. So there's no exact answer, but it's got to be educated.
That feels like a departure from where we were like 5 years ago,
Yeah.
where it was all about top line growth. It was like grow, grow, grow. We'll figure out profitability later. Are you seeing like a shift now?
Totally. Oh yeah. I mean, even we focus mostly on supporting pre-seed and seed. So they're typically raising between 300K to 3 million.
Okay.
Some Series A, some earlier stage going for grants, but in that range, it's about how you're going to preserve the business, because you're probably going to have to raise again. Yep. They're not going to be paying founder salary. So how are you fueling the business? It's number one.
Yeah. And you know what? I want to get into that as well. That made me just think, hit that like button, get in the comments. I want to know what your thoughts are. If you have questions for Kat, if you're thinking about starting your own business, if you're pre-seed, if you're pre-revenue, I want to talk to you out there, get in the comments here. But what are some of as a person that's pitched successfully 25 times, what are and as a person that's judged pitches, what is some things that you look for? Maybe, what is something you look for? Let's be positive first. What are green flags?
Okay.
What are things you look for?
Green flags. I would say, and this is generalized, so whether you're pitching for a grant, retail, investment, strategic partner, I'll give high level of something that's going to be applicable to all of those things. So the first one is researching who you're speaking to, audience.
I feel like that's like good principle, but I could totally see people not.
Oh, no one does. Everyone thinks about themselves. Like 99% of the time, founders love to talk about themselves. They love to make it about them. They love to talk about what they think the audience wants, not what the actual judging panel needs. Let's say the majority of time, and if you're in front of someone, they've got a rubric to actually score you, or at least a mental rubric. You have to do your research on who they are, so you're speaking to them for them.
And how are some of the ways that they might like that? Some of the differences in the folks you're talking to, like how might they be different?
In what ways?
Well, I guess I would assume, like, if I'm going in a pitch, I'm like, we have investors, but like, I mean, how do they differ? Like, is their strategy different?
You have to think of what is the action that you want to incite from them. So let's say it's not for a particular dollar amount, or let's say it is at first dollar amount. What impact are you bringing that they feel compelled to give you that money? Okay. And two is, let's say it's a general audience and it's not a cash prize or something like that. What would you say to make someone come up to you after and take action on what you're talking about? Which kind of leads me into part two of positive is you're educating me as an audience member and I'm not your target consumer. Like, don't treat me like I'm going to go in the store and buy your product and love it and force that word that I'm going to love it down my throat. Like, I shouldn't have to be a consumer to be able to understand who you are and what you do and who you serve.
Yes. So you're not selling the product, you're selling the business.
You're selling the business, but you have to be the educator in it. Like, you're not selling it to them, you're educating someone so they can go pitch it to someone else in the room. Like, they should be able to sell it to someone else because they would know who your target consumer is and think, oh, this person would like it, or this person would know how to help them in a way.
So I want to ask, like, red flags. I think what are some of the things?
Be here all day.
What are some of the things you've seen? What are some of the things you've seen where like, ew?
Number one is pitching is if I am a target consumer.
Okay.
Like, so on the flip side, like, it's good if you don't, but we have so many founders who are like, you're going to love it. Everyone loves it. We're best in class. Or they'll talk to me like I'm in their industry. I don't have to fund them to be able to be in the industry specifically. So, and that opens a can of worms in a lot of ways, but that's the biggest issue we see is talking to people like that, not following up.
Oh, really?
Because if you have any pitch event, you're in front of a panel of experts usually. Or if you're pitching to someone that you met on LinkedIn and you don't do a follow-up or request something, it's never going to happen.
Do people assume they're going to like, it's like the Shark Tank, like at the very end, like Mark Cuban's going to stand up and like cut you a check for $1 million
and shake your hand and
shake
then
your hand. It's like give you the rose,
which doesn't
won.
happen. There's more meetings outside of that. We've helped several founders pitch Shark Tank. There is more negotiation and due diligence that happens after. You don't get a check right after you leave the show.
So you've actually had some of your clients and people that you know on Shark Tank?
They're actively pitching, filming now.
Wow.
Yeah.
More than one?
Mm-hmm.
Wow. How do you do that?
Great question.
Well, everybody watches Shark Tank. Everybody wants to be on Shark. Or in the UK, I think they got Lion's Den or whatever, Dragon's Lair. Or,
I think it's Canada, Dragon's Den.
Dragon's Den, and then
it's a similar form. It's more gamified, so it's more. It's TV, right? You have to make it fun.
Yes,
but
so personality is a part of that.
Definitely, but you still have to be able to describe the business, what your terms are, how you're better than what's in the market. So there's still a standard format of a classic investor pitch, but it is a little more gamified. It's supposed to be more fun and have a bit more marketing aspect to it versus a pure investor one, because you're on TV, but actually half of the companies who pitch, only half get aired. A lot of people don't know that. Yeah.
So they film twice as many and only air half of them.
Mm-hmm.
Oh, really interesting. And get in the comments here. I want to know what questions you have. I see a couple comments coming in. Hit that like button as well. I've seen one of the things I've seen as I've watched people pitch is when they haven't researched the market and don't understand who their competitors are, or think nobody competes with them, or don't realize that alternatives are also competitors.
Yep.
And they're like, oh, this has never been done. No, this is not on the market. It's like, well,
there's no such thing as having no competition. It's literally impossible.
Yeah. And so that tells me like automatically, like that shoots the credibility down for me. And it's like, okay, so if you're not doing diligence on that, and I can easily Google and easily figure out, or easily as a consumer identify, what else are you not diligent about?
And a lot of people think, or they don't outline it because they think it's a negative. When if you know what's in the market, that's a positive. You've educated yourself.
Why is that a positive though?
Because you've educated yourself. You understand the elements that they're really good at and how you're going to win. You're telling me how you're going to win. And then you know exactly what points are going to be proprietary to you or not. So like we had one founder in the beverage space yesterday said, oh, we're better on price, taste, and branding. I said, you're not a household name because you have a brand. That's not a differentiator. That's not a competitive advantage.
You're not Coca-Cola, so nobody knows your brand.
And on price, actually quantify the price so I know what that's like. And on taste, don't say you win on taste unless you've done or surveyed and done an actual taste test.
With empirical data.
Yep, it's totally subjective. So you need the facts and stats. A negative is using the high-level fluff language, buzzwords, as we say. Revolutionary, disruptive, I'm the only one. I mean, I could go on all day.
One buzzword you highlighted that kind of struck me to my core, because we like to use it a lot here, is we do like to say that we place transformative candidates. And you said you said something, you were trashing transformative.
Yeah,
I know
100%.
you're my people, but I love that word. I stand by loving it though.
Okay, so why is it transformative?
Hey, I'll tell you why, because it changes the trajectory of the business. So when
what makes them transformative?
They transform the company that they go to. So when I bring this person in there, they're such strategic, they're a rainmaker or they're strategic leader or something. So when they enter the business arc is doing this, and they come in and then the business does this.
So what level of growth or transformation, like what percent do you average from the people that you bring in?
Well, it's situational based on the person and the role.
What's a range?
A range is, I mean, I think a year, I mean, you're talking about year-over-year growth for a business that's somewhat mature, 10-20%.
So instead of just saying transformative, how about we bring in, if you got to use transformative, okay, but we bring in transformative, what do you say, candidates?
Yep.
We have transformative candidates that average 10 to 20% growth for the positions that we put them in.
So you're saying you want to substantiate that?
Yeah, back it up.
Yeah.
So if you have to say that,
Okay.
prove it. Or the point is that if let's say you say that range 10 to 20%, someone's going to feel that you're transformative without you having to say it.
Sure. So it's like, don't tell me, show me.
Exactly.
I got you. I love it. Christine Hansen saying you have to sell yourself and your product or concept. What's more important, the product or the team?
At the early stages, the founding team is more important. We say investors buy into you before what you do, because you're driving the ship. You're probably going to pivot. It's probably going to be things that happen.
The product's going to change. So it's like.
Exactly. So later stage, it is about the product and your growth. But early stage, it's absolutely about the founding team. And I've made personal angel investments based on the founder being the winner and the change maker.
Right. You just want to buy stock in that person.
Yep.
Because you know they're going to figure
I'm betting
it out.
on them because that product will change.
That's so interesting. Does that make it harder, easier or harder going into a seed round, knowing it's really about you and not the product that has wins on taste, price, and branding?
I think it's powerful because your story and your expertise and background is proprietary to you. The product, anyone can go knock that off, no matter how many patents you have, no matter what formulations you've got, anyone could go write that off, but you get to lead the brand and showcase your expertise, connections, power, grit, experience, whatever it might be. That's literally proprietary to you at that point. So it's a good thing.
Yeah. Love it. Hit that like button. Get in the comments here. If you have questions, I've got questions, but you know what? Hey, we got Dan in Tulsa. Is there a relationship between capital requirements and the timeline towards profitability?
Sure. In the sense that, and hopefully I'm thinking of this correctly, it's like, you'll reach a different type of investor and investment timeline in terms based on you understanding where you are going to be profitable and at what point. So it depends if, there's revenue and debt-based financing options, or if you're going the investor route. I mean, at the end of the day, debt is cheaper than equity, which is a great thing.
Explain this a little bit, because there's people out there that might have an idea, but they don't understand debt, equity, revenue based. I mean, you said a lot of things out there. So explain that just a little bit more. Double click into that.
Okay, so there's a lot of different ways that a company can secure capital for the business. Now, it's over glorified from Forbes, TechCrunch articles that founders want to go after venture capital, which venture capital, essentially, you give up a percentage of the company in exchange for cash to help grow it. And the investors make out upon a liquidity event, meaning that the company gets sold, IPO, whatever it might be. The point is they're taking this risk to put in money to get 10, 100, 1,000x their return, whatever it may be.
Okay.
Now, venture capital, 1% of small businesses in the US actually end up securing venture capital. So it's a very small amount. So the debt and revenue based side is you can go after, look at banks, lines of credit, specific loans, whether it's for, let's say you get a purchase order for a retail product or it's equipment, things like that. They can be able to track and look at the leverage that you have with those things. So, they're also making an investment in you to pay that back. It's a lot of different options. So building a relationship with a banker is key. And we could be here all day on that. There's also crowdfunding options to raise money from your fans.
So those situations don't require you giving up a percentage of your business.
Correct.
You're going into debt like a credit card would, but you don't have to give up equity.
Yep, which is why debt can be cheaper than equity, because you still have control of the company longer term. Let's say you pay that debt back and you have a bigger growth point valuation, you end up selling, you keep more of that company in that piece of the pie yourself.
Yeah, I love it. Let us know if that answers your question. If you got follow-up questions, we got James Moss checking in here. If you've got questions out here for Kat, this is really interesting stuff. What do you recommend? Do you recommend people take debt and take loans, or do you recommend giving up equity? And I got to think that there's a point in the business where you can't really get loans, or can you get loans if you're pre-revenue?
Usually not, which is why I recommend grants.
Okay.
Grants are non-dilutive, I say enterprise level, which are grants between $500 to $250,000. There are government grants. It's a bit more extensive, but
for private enterprise too.
Totally. So
I can make the next hard seltzer out there off a grant.
I won 6 figures in grants and never had to pay that back.
Wow.
It's not a loan. It's not debt. It's not taking equity. It's literally a check, cash in your bank, like from pitching, and it's smaller amounts of capital on the enterprise side. But like the FedEx Small Business Grant, things like that are particularly meant to give checks and growth to small businesses.
I want some grant money.
Yeah.
We got to talk offline about that. I want some
grant power program, power2pitch.com. That's what we do.
What is that? What is that URL again?
It's power2pitch.com/grant power, or you just go to power2pitch.com. We share $250 up to $250,000 grants, 200 of them every single month. And I have the education on how I won 22 of 23 grants. And so we want to encourage more founders to get access to that. And it's typically you got to be under a few million in revenue or capital raised. And even if you're just idea stage, there's this one grant, no joke. It's 5 questions. Submit your idea, your super cool, amazing, awesome idea, and they give out 1 to 5 grand every month.
Wow. That's awesome. Get in the comments. I want to hear your questions about this. I'm fascinated about this grant money. Power2pitch.com/grant power. Really interesting. So you won 22 out of 23 pitches. Why do you think you won those pitches?
I spent hundreds of hours practicing.
Okay.
I never just showed up. I never used a note card. I researched the audience. I curated my pitch specific to the opportunity in that moment. And I was also told this a lot of the time by the judging panel. So sometimes it was written and sometimes it was in person or virtual. But I was always told that I had the best and most clear ask with that money in that moment.
Ooh, what does that mean?
So for example, if a grant is it's a $10,000 grant. I wasn't saying, oh, I need $100,000 to go do an X, Y, and Z. It was, I'm going to have a certain ROI and impact. The second this $10,000 hits my bank, it's going to do 3 to 5 very specific things for me and give a certain level of return. And a grantor wants to give money to someone going to do the most right by it. They want to interview me in 1 year and see where I am. They want to do PR campaigns like FedEx. They had me on their Facebook ads. They flew me to Memphis. I spoke on I was on their advisory board. I'm in their website campaigns. Just because I was so specific of FedEx is going to help me in these ways and your money is going to help me in these ways. And then selfishly, they want to promote you to say, oh, look at us helping these small businesses.
Right.
And rightfully so.
Right.
And then they get tax incentives to do that.
Wow. Yeah, that makes so much sense when you say it like that. I mean, if I'm going to give you a big check to you, I want to know where that money's going.
Yeah.
And I love the fact you have specific allocations for it. You're telling me exactly what you're going to use it for and how it's going to further the business. The ROI I think is really interesting. What do people do wrong when they ask for money? What do they do that's a red flag? What did some of your competitors in this pitch do maybe that they shouldn't have done?
I'm gonna get you a red flag, like actual one, to just like wave.
I need red flag. I'm a walking red flag.
So a big one is using the money to pay off debt, to secure office space, pay rent, pay themselves a salary.
Why are those really terrible ideas?
Because it is to maintain or pay off certain things and not grow the business like this, like hockey stick growth.
Mm-hmm.
So they want to see that, like $10,000 grant, for example, they want to see you 3, 5, 10x that. And just paying an expense is not going to help grow the business. Yep. So the expenses are a huge red flag. Rent, and a lot of people, I got some flack. They were like, oh, you're paying yourself with all that money. And I was like, no, I'm not. It's going inventory. I paid people. I lived in my parents' basement before I got a warehouse. Like 100% of that money went to going towards the business and changed my whole life. All of that was, I actually got more from PR, marketing, advisors, connections than the actual money itself.
Yeah, I see this sometimes too, because I also work with businesses that try to, they're trying to be acquired, right? And they ask for these valuations, and a lot of times it's based on the salary that they could get if they were to become an employee in the market. Like, oh, I'm a $250,000 employee, or I was before I quit my job to become a founder. And so I'm trying to get back to that level of lifestyle. And it's like, okay, you're not going to do it off $500,000 a year company.
Investor is not going to invest if you're, I mean, there's a point of you being able to survive and run the company, but like they're not paying your bills. That's not why they're investing. They want you to be a little gritty.
Yeah, and to be honest with you, if they wanted to do that, they would just hire you as an employee and say, bring your idea over here. We're going to own your patent, and we're going to, you can be an intrapreneur, not an entrepreneur.
Yep. No joke. We had this one founder who had 0 sales, is in the MVP stage with this product.
MVP.
Minimum viable product. So very idea stage, not even something tangible really.
Wow.
And like as early as you can be. And we had, she said she went to all these big universities, everything, and she was going to pay herself $250,000 a year. And she was raising $750,000. It's a good chunk of that money. And it was because she's worth that as an engineer from her previous tech job.
Oh.
That will never fly. And we said, good luck getting anywhere, but we will not approve that or make intros for you because it's not realistic.
You want to be an employee. So go be an employee. Go get that job. Go take that job. I'm sure they take you back. You were wonderful. But you can't, you know what I mean? You can't have your cake and eat it too. You can't have equity and
you gotta sacrifice.
Income.
Yep.
You have to put the business ahead of yourself. Is that a hard thing to teach folks? I mean, is that, or do people get that intuitively, or do they have to, is that a real come to Jesus moment right there?
The salary thing?
Yeah.
You know, we see that it's getting more and more common.
You're going to go from bright to broke and be there for a minute.
Yeah, and I think, well, one, there's a legal aspect of it too. So if you raise a certain amount of money, and there's a lot of people who went to jail for this, it's called self-dealing if you do not disclose that you're going to take a salary.
Really?
And you pocket that investor's money and you go run with it. There was this one founder who was partying and got this crazy new house and all these things, and investors like, what's happening to this company
that's why I don't raise money, because that's probably what I would do. I need to bootstrap it, or else I'd just be way too bougie too fast. I would just be like, all right,
look at these,
we got boat money, this is Wayfair, Black Friday, this is chairs. Oh my gosh, I'm getting crap from the chairs. Jose Botley checking in. Hit that like button, get in the comments. Jordan checking in. I don't know what you're talking about, Jordan. Requesting a quant. All right, cool. Hit that like button, get in the comments here if you got questions about raising money. When should you raise, and when should you just suck it up and self-fund and just bootstrap?
Great question. And a lot of people get confused about this.
I take comments where I can get them. Okay, I'm dying.
No, it's a really great question. It truly is. So we say, even though our specialty is helping founders raise from investors, go and bootstrap as long as you possibly can. Go for grants. Take out that 401k, like get gritty if you really believe in this.
Take out that 401k, because
that's
burning the boats right there. That's
burn the boats. Do it all. Like if you're into this, I've always been a founder, and I've gotten to the grittiest of gritty levels, losing things to a fire, living in my parents' basement. And I was lucky to live in their basement, but I had nothing. I had no handouts. I did it all myself. And it's like, I see a lot of the best founders, the ones that have to get gritty. So if you're all in on something, you're going to regret not doing that, but it's not for everyone either. So I'm just prefacing, but self-fund, use family and friends, money support, if that's an option. Get gritty, do it as long as you can for yourself, as long as possible.
So when do you know it's time to call Kat and say, yo, I need to go to the market and try to raise some money? This is my old school phone, by the way.
So when I answer, it's got to be that you're looking for a strategic investor. Okay. You are not supposed to take just any money. Not all money is good money. Not all investors are good investors.
What, just define for the people out there, just strategic investor, what differentiates them from a regular investor?
A strategic investor, let's say you have a granola company and you want to expand your retail footprint of having your product on shelves. You would want to find an investor. Let's say you've tried everything to get through certain strategic retail contracts, negotiate manufacturing prices, co-packing, whatever elements to bring the product to life and on the shelf. Okay. And you kind of hit your max in terms of connections, money. You're going to want to find an investor who either knows the consumer product world, knows that the product is something that will expire. Okay. They have maybe retail contacts. They've helped a company exit or grow in the consumer product space. So you're going after someone who can be strategic for you, they're not going to be a silent check. There's really no such thing as a purely silent investor.
You can get money and access
Yep.
or and wisdom versus just getting money.
That's the point. You want someone who can bring value outside of pure dollars.
Yeah. Yeah. So like when we're watching like Shark Tank, I go by Shark Tank because that's everybody's reference point, right? So you're watching Shark Tank and somebody's got a consumer goods company and they're like, I've got the new ShamWow, and Lori's like, I've taken a million things to QVC. And you're like, that's who I want. Or
exactly.
You know, or you got a sports thing and Mark Cuban's like, I can introduce you to LeBron.
Exactly.
You're like, yes, that one. How do you find these people though? Like, how do you find Lori who's taken a 1,000 SKUs to QVC?
Well, a warm intro is always best, right? So trying to filter through as many mutual connections you might have to someone. Sometimes someone that big is such a big fish. You don't need that person. Like there's other QVC experts, right? There's other ways to get your product to market. So that's over glorified, I think. But a lot of founders don't realize that asking their network to make warm introductions, one, if possible, two, searching LinkedIn and Twitter, sometimes even Crunchbase. A lot of investors have that on their profile and what they invest in. So you don't want to waste time. Let's say the investor has a profile and they invest in companies, let's say later stage. That might be 5-10 million in annual recurring revenue. Everyone has their own definition, but a lot of the time their fund or in their personal thesis of what and how they invest in check size, they'll say that directly. So you don't waste their time. And then you can make and do direct outreach based on researching the audience and that profile to ask for a 15-minute meeting and get to know them.
So what I'm hearing you say is it's really important to kind of stay in that niche in your industry and find investors who specialize or executing strategies in your niche.
Yep.
So every investor's not created equal just because we say all money's green, everybody's dollar spends the same, but
not in this world.
But not necessarily. Do you also find that like certain investors bring in other investors, like they kind of flock together, and if you can like get one, then three more might come along with that, or is that a little or are we a little early stage for that? And James, I'll see your question.
So there's this really great VC podcast called the VC Minute. I'm going to plug Rich Malloy. He's a great friend. It's a great resource, and he calls this concept the pool party. So when you think about you're at a pool party, not everyone wants to jump in the pool as invest. But when one person just goes for it and it seems like fun, it's so much easier for everyone else to jump in.
Yes.
So
no one wants to be first.
Yep.
But once the party's going, it gets easier and easier. It snowballs.
Yeah, we've had a ton of founders. They're like, oh, I have this commitment, but I have to get a lead. Meaning that lead investor typically would do the most due diligence on you. And then these smaller check sizes would say, all right, I trust that person. I'm more quickly going to invest.
Love it. Love it. Get your questions into the comments. Hit that like button. Check in with us. We got a question here. We got a couple questions coming in here. James Moss says, where is better to raise for tech, Silicon Valley or NYC? Or does it matter?
I'm not the end all be all. I don't have every connection everywhere. I would say it depends on the industry, stage, what you want, the connections you want, the environment that you want to be in, because New York is very different than Silicon Valley, and so is Austin and Dallas and all those things. So you really have to build out this profile of like a life and the connections that you want, and then deduce who do you know there, who can you plant a seed with to help make connections for you. Because if you go plant yourself in either of those cities, where are you going to be starting from? So
it's more about your network and who's in the pool already and at your pool party almost.
Yep.
But I imagine though that same doesn't hold true. And I'm going to pick on Tulsa. My dad's from Tulsa over here, and I know Tulsa's been trying to make waves in the tech scene, right? Everybody's a new tech hub, right? But Tulsa with a good network are you telling me that's better than no network in NYC or no network in Silicon Valley?
I just think there's all this media out there about everywhere you go. You're going to see all this fluff and fakeness. And so you got to do your own due diligence. It's not in the news. It's about the connections. It's about being in the online communities to ask about that stuff, make connections ahead of time before you uproot your whole life and go there. I think is important.
So just moving there and thinking, hey, I'm here, y'all. Like,
good luck, but I would.
Like, oh, thank goodness you showed up. We were short on startups out here.
Yep.
No, right? Okay. We got other questions coming in. Get in the comments here. Let's see here.
Oh, I like that one. Is there anything?
Let's see here. Look at her moderating my podcast.
Sorry.
Already coming in, modding the pod. Okay. Has there been anything that surprised
You're
you?
gonna miss it.
I mean, come on. I got 3 comments. I'm not gonna miss. LinkedIn user. Who's LinkedIn user? LinkedIn user says, "Where you at?" All right, whatever. Has there been anything that surprised you that turned investors off?
Oh, there's plenty of things that can, but so I've mentioned before that out of all the small businesses in the US, 1% actually raise venture capital. So out of that 1%, 1.9% of venture capital has gone to female founders out of that 1%.
Wow.
And 0.13% of that has gone to minority founders. Those are
Wow.
public stats. So
Wow.
it surprised me that there is actual fact out there in a study done that women return, I forgot the exact numbers, but they return more per dollar invested than male founders.
Wow.
And so it's surprising to me that there hasn't been a quicker turn of investment and support towards more diverse teams in that sense, because there is data for that. It's a fact. Even diverse teams in general. And so I think that that's super surprising. We actually, one founder my business partner knows, so she had already raised money, went back to her round of investors, said, I'm raising again. I want to give you first rights if you want to reinvest before I open the round. And that investor said to her face, I will not invest again if you decide to have another kid.
Oh.
No joke.
And she had one already and done well.
Yep.
And then thought, oh, wow.
So the motherhood is an issue in the fundraising realm when I think mothers are more gritty. They prioritize better. They know how to sacrifice things. They're better at multitasking. So I think moms are super powerful in that space, but I see a lot of negativity around it.
Yeah, that's sad. I see the logic that person's trying to say, but if you also look at past performance, the person already performed. And so and to your point about grittiness, I mean, there's nothing grittier than a mom. I mean, it's just incredible. So now if you see this, I mean, to me, that sounds like an arbitrage though in the market, right? So if you see female founders are returning more ROI and are underinvested in, it seems like people should have whole strategies dedicated to
there are some
exploiting
funds
this
now.
arbitrage.
There are some funds now that are having a more like diverse team focus. So there's actually a fund in Dallas that did this. They kind of did like a mini study with a small amount of capital, and they found that the female founders specifically returned 7 times more, which was pretty interesting.
Ethiopia said, there's no logic behind that. Fair. Okay, fair. I mean,
logic
there's
behind
logic.
What?
It's flawed. I commented, I
yeah.
can see the logic, but I'm not saying it's correct. I'm sorry, you were saying though about the Dallas. You were saying about the
No, so within their
fund.
study, it was like 5 or 7 times more per dollar invested with the diverse teams versus purely male founded teams. And so now their fund requirement is your founding team or like board members you have to be diverse. Like you have to have a diverse set.
I think that there's real opportunity there. I mean, what you're bringing up, I mean, it sounds like there's not as much demand, but yet they're outperforming. Ethiopia, I believe it's Ethiopia. McKinney says, how would VC work with nonprofits?
That's not standard. Nonprofits typically, in what I've seen, get more success and money from government grants, enterprise level grants. The VCs make out on growth in a liquidity event. So they're super high growth. Nonprofits, that's not typically the business model, is this super, super high growth and returning the fund.
Well, because how do you return funds? How do you return value to shareholders in a nonprofit?
So it's a totally different business model. It's not really meant, VC is not really meant for nonprofits.
So maybe grants,
enterprise level government grants. There's tons of community support. You can go to your Chamber of Commerce and get, or even sponsorship in that sense. It's not typical that a VC would go for the nonprofit route because the VCs, let's say, for example, they invest in 10 companies a year. They're banking on one company to help return the fund because they've had this like super high level growth and they're expecting the majority to fail, some to just stay even. They're not planning on and don't operate on them all being winners. It's like they want one super, super big hit in a type of company. But again, super high growth, proprietary elements. It's not typical of a nonprofit.
Interesting.
It's not to say it's not a good business. It's just not meant for that type of capital.
Yeah, interesting. Mike Quigley, some investors are intimidated by the high dive into the pool. Is there a gradual walk-in, or can I wade? Is there a kiddie pool maybe I can start with?
So in relationships with investors, I like to say treat it like a marriage. You start dating, you got to get to know each other. You got to know where their strengths and weaknesses, the good, the bad, the ugly. I think there was some stat, I don't know if it's up to date, it might be a little outdated, but like the investor relationships last longer than most marriages.
Oh, wow.
Because they're with you until you sell the company and you buy them out.
Well, the investor has to wait to exit.
Yep. Or unless they're literally bought out. So in terms of intimidated by the high dive, is you should be building relationships with investors before you're ready. A really good way to do that is, especially if you seem too early, is asking the investor, hey, if I'm too early now, what KPIs, key performance indicators or metrics do you want to see when I come back to you when I'm ready? And then putting them on an investor newsletter. So we tell our founders, have something quarterly where if you've had a good relationship, you're too early, ask, can I put you on this newsletter? It has updates. It's very high level. I send it out, a quarter, whatever it is, and they'll keep seeing your progress. You should have asks in there. You should have the metrics that you're going after and company updates, things like that. So you're building the relationships. You kind of got this like kiddie pool relationship with them in a way. So
they're at the party, they're just not in the pool.
Yeah.
So in that investor newsletter is different than, say, a customer facing newsletter, because maybe you're talking about more business metrics and how the company's performing versus, oh, we're launching a new beverage. It's more like, here's our quarterly overview.
It could be financials, product updates, progress, anything that would get an investor excited about company growth. And then the best thing to have is an ask. One ask, one super small. So if the investor's like, you know what, maybe I have this connection, you never know that relationship that you could be building with them from that.
Well, you just got me an investment offer. Actually, I've got my first investor. Mike Quigley said, I'd like to invest $1 million into LOVE+RELO. Mike, I'm going to add you to my newsletter if that's okay. You can talk to Kat, my representative here, who will be happy to shepherd you through that decision-making process. I'm going to tell you it's going to all go to my salary and my boat party. So if you're comfortable with that,
you're invited.
Of course you're invited. Of course. We got to take care of the shareholders. Mike's awesome. Love Mike out there. And that is binding, by the way. It is in writing now. Bruce says,
we have proof.
Yeah, Bruce says, I moved to LA from DC, and within a year I leveraged the community here heavily. The network matters. It changes your experience, and with strategy you can get positive outcomes. Bruce, did you get funding? Did you, let me know. I'm really curious about that. So let me ask you, I'm, selfishly here, not self-dealing, just selfishly curious. So I have a startup. Glomo's been around for 4 years. We do recruitment, do consulting. Is my business the type of business that should go out and seek funding?
It's hard to be in the service space.
Should I accept Mike's offer of $1 million?
Well, you said boat party I'll cover, so I mean, it seems like checked all the boxes. So that's answered itself. So that's all I gotta say.
But all seriousness, like I think about that, like, because I want to scale. You want to take over the world, get these BHAGs going in your EO group. Your big, hairy, audacious goal, and you're like, okay, in 10 years, I want to be up here, right? And
like, what is your process? Do you have like any technology? Do you have like
off the shelf standard industry stuff?
So what's proprietary about what you do?
Proprietary is the podcast, the community that we've built, the way that we understand our niche. I would say probably the way we go to market with media and promote ourselves.
So that's really heavy service.
Mm-hmm.
That's not a typical model that an investor would be excited about, because if there's not a technological aspect, or like the majority of your community is who you rely on, how you get feedback and all that, like it could be part of the marketing, but that's not typically something that they would find to help return a fund or exit value. But if they could come to the table and say, hey, I have all these connections for you in this space, I'm going to get you all these clients and support you in a very, very specific relationship based way, then that's something to consider.
So I would need to maybe add a little more of a tech or a scalable aspect to my sauce in order to appeal to I don't know if it's VC or PE at this stage?
PE is super high growth, way later stage. So PE is not really something to think about. We don't even focus on that. Those are like multi $100 million-ish deals.
Okay. So I'm be looking at venture capital, and I would need to have some sort of a technological.
I would say angel investor. Angel investor you can find earlier than venture capital has a bit higher growth expectations. They're not going to be as involved or maybe as excited or pick up the call like an angel investor who's super strategic and might be on your side, and someone you could text back right away would be more strategic.
So really, Mike, all kidding aside, like, so Mike's in our industry. He's a friend. He's known me for years. He's a fan of the show. You know, he's the type of person. He's an angel investor. He would be the type of person. He's bored. He's floating in his pool in Florida right now. He's like, you know, got nothing to do with his million.
What's your exit plan? Like, do you have a year and a dollar value?
No, I would need that.
So that's what you would want to express.
Because Mike would want to know when he's getting his mill.
Exactly. He wants to 100x that $1 million.
So he's not just looking for me to cut him a 15% every year dividend.
Unless you have that specific conversation and an attorney set up what actual like your distributions would be based on that. A typical investment based on the funding instrument, which is more technical, that you would use, you're waiting until an actual company exits. So for example, I invested in a non-alcoholic premium beverage company called Cheeky Cocktails. They've got backing from the Kardashians and all this cool, crazy stuff. I joined as an advisor because I know I have made strategic connections for this person. I've made investor introductions that have converted. And I like the product. That I don't have to, but I do like the product. Now, I'm not getting paid out every year. I'm waiting until she gets acquired. Yeah. I'm helping her grow as fast as she can so I can get a return on what I've sent her.
Wait, no, Seagram's or Diageo comes along and scoops them up for $500 million.
Exactly. Love that.
That would be dope. All right. Awesome. Mike's been called worse. Yes, you have. By me. Anyway, we've got stuff going on. Hit that like button. Get in the comments here. Put your questions here. We've got a really cool top 5 resources for you. Let's get into that, and then we'll do overrated, underrated. You ready?
Bring it.
All right. Top 5. Super producer Adam, cue it up. Kat's top 5 startup resources. Kat's top 5 startup resources. Let's go number 5. We're going to go countdown.
Number 5.
Number 5. Don't worry. I got it. Hello Alice. What is Hello Alice?
Hello Alice is a platform that shares grant opportunities. So non-dilutive funding. Remember, check in the mail, bank, you don't have to pay it back. It's not a loan. They share a ton of really great opportunities.
Nice. Number 4. YouTube.
Free
Free
resources.
It's like Google.
Education. It's literally Googling. You get to see pitch examples. We have a channel where we talk about, from everything, should you send NDAs, what to think about grants, things like that, in our Power to Pitch channel. But YouTube content is free. There is nothing you can't teach yourself. Yes, there's a lot of noise, but there's too much free stuff for you to not try to get educated there first.
Should you send NDAs?
No.
Why not?
It's a barrier to entry. There's nothing too proprietary about what you're doing. And if you're too scared to share your idea, good luck.
Yeah. And if you don't trust them enough, just have a conversation. I mean,
you
probably got other issues, But I think people are just so covetous over their idea. They're just like, oh, I could never. As soon as I tell it to somebody, somebody's gonna leak it to the Wall Street Journal, and like
investors usually they don't have time. Like, I'm not gonna steal. I don't have time to steal your idea. There are some predatory people out there. Don't get me wrong, but if you've done your research on the person, and they don't have someone competitive in their portfolio, talk about what you do.
Yeah, I love it. Research the person. Back to research the person. Number 3. Forecaster.
So I love this platform. We actually recommend all of our founders get startup financial modeling. I made a huge mistake my first company that I didn't use an accountant and support of someone who actually knew that I was a startup and the type of business I was in. And when especially you're going after investment and you're trying to figure out with banks and the money and all the things that you're doing, you need to have projections, an idea of what that's going to look like. Yes, they're guesses, but they should be educated guesses. So it's the most affordable thing you can do as a founder. And Forecaster, we know their team. We've worked with them for quite some time. So it's our #1 recommendation for startup financial modeling.
So this is like back in the day when they said you need to have a business plan, you need a pro forma and all that kind of stuff. I mean, is that what Forecaster does for you?
Yeah, so they can build a pro forma. It's just thinking about like the projections of the business. And especially if you were, let's just say you want to forecast the business out itself of what you need, who you want to hire, what that's going to cost. And then if you go to raise money, what's that going to do for the company in terms of growth? What is that money going to look like? And what is going to be the return at some point? So someone else who calculate that.
So can I use this platform even as a business that's been around for 4 years?
Oh yeah, it
budget,
would be great.
Maybe budget or model for the next year or two?
Yeah, I can get you a discount.
Wow. Look at me. All right, I'm winning. Awesome. Number 2. Can't count. LinkedIn. I was going to ask you about this.
That's why it's so high on the list.
Yeah.
LinkedIn has brought me the most incredible connections, business. I would say 95% of our business and support comes from LinkedIn, and we show up authentically. And my whole intention when I started to kind of post and consistently was like, if I could just help one more founder with stories or mistakes, resources, it's free. I just want to share it out there, share links to grants or opportunities. And it's truly changed my life and my business. I've gotten speaking opportunities from it. I've coached cohorts because they see the credibility that I have on there. And then when someone posts a recommendation about me, it's not me saying it. They have to post it from their profile. So it's got
there's accountability
so much to it that it's free to post. It's free to have an account. I don't even pay for premium yet. I don't even know what it does, but it's an incredible. You can find investors on there. It's endless.
LinkedIn, if it's possible, I think LinkedIn is so underrated. I really do. I've built like a whole career off just being on LinkedIn. And what's cool about it is you can search people by their job function, connect with them in a very easy, harmless way. It's not like Instagram where somebody's like, who's this person's going to follow me?
I hate their outfit.
I don't know if I'm going to, it's like, what's the harm in connecting with somebody unless you're going to follow up with like 8 million spam messages? So you can put people into your ecosystem and then just publish all these updates or all these thought shares and just funny stuff, all sorts of, and it just appears on their feed now. And you get so much targeted free advertising. It's ridiculous that people don't use it more. I mean,
reach alone from
it's the organic reach. Unreal.
Yeah.
Do you do any LinkedIn like advertising? Have you ever recommended your clients to like paid ads or anything? No? Yeah,
I think it's really spammy there. I don't like when I see them. So I was like, why would I do that if I don't like it?
Fair.
So I post enough where if someone resonates with the content, they've gotten value, and they want to go to my profile and see how I can help them, all that information is there. I'm not going to push anyone. And we reject applications who don't fit if they're too early for our programming. Like we can't help them. So all that is clearly there to say, if you've done your research, this is exactly how we can help.
Love it. Number 1, Startup Stack. What's that?
So this is a killer list of resources. There's over $500,000 worth of tech perks that you can get from this platform.
Like discounts and stuff?
Yep. Discounts to our grant program. They're listed in there. We got a $25,000 Stripe credit because in processing fees waived.
What?
Yep. Through this, I got QuickBooks discounts.
Did you have like 8 million scholarships when you went to college? I feel like you were the person like filling out every application.
I played tennis.
Oh, so you were already
that was my thing. Well, that's why when I was running the business, like I couldn't go get a job. Tennis was my job.
Yeah.
So, but all like the grants, all these credits, like we got 10,000 in Google Cloud, 5,000 in AWS. It's not a check, but we're using those services anyway. So why wouldn't I want to get that for free or waived?
That $25,000 in Stripe credits. Shout out to our friends at Stripe as well. But I mean, that's crazy because if you think every purchase is 2.9% or whatever coming off,
plus 30 cents per transaction, it's going up. That's what I'm saying.
I mean, you're putting $25,000 literally back in your pocket after, I don't know, $100,000. Well, no, $1 million worth of transactions, basically. Wow. Awesome. Those are really valuable. Okay, cool. Let's get into overrated, underrated. So this is the last segment of the show. Do you know how to play this game? Overrated, underrated?
I think so. I kind of get the concept.
Seems intuitive, right?
Yeah, I hope.
All right. So I'm going to give you a topic. You are going to tell me if it's overrated or if it's underrated. You only
Cool.
get those are your only options.
Okay.
Okay. Don't overthink it.
Sure.
All right. And then secondly, I will tell you if you're right or wrong. All right. Let's get into it.
Doesn't sound subjective at
Yeah,
all.
super duper. Anyway, let's get into it. First one up. Pitch decks, overrated or underrated?
Absolutely overrated. If you want to fight me on
Overrated.
this, if you want to fight me
How
on
do
this,
you
we can
pitch
go.
without a pitch deck? Then it's just a deck. Now, how do you do it?
You have verbalized. They're buying into you before what you do. We've had founders get investment with just speaking to someone. No pitch deck needed. It helps, but a lot of the time it's overdone. It's a crutch. It's way over explained. You're way oversharing, and it takes away from you speaking as the founder.
Yeah, it's not, it's inauthentic. It sounds like you don't actually know what you're talking about. You can't just talk about your business. I agree with this. I think this is true in sales of all types as well. I think that, even in EO, right, in our entrepreneur organization, I have people that want to kind of do more B2B, right? So I talk to them because I've been doing B2B sales for a long time, and people are like, "Oh, I need a deck. Oh, I need a deck." I'm like,
kills me. Or they're like, "Oh, wait, I can't tell you. I need to show you my deck first." And I'm like, if you can't explain what you do without a deck, you got a lot of other problems.
Yeah, like, do you actually know what you do?
No.
Or do you need to read it off slide 5?
Yeah.
And then you're just reading a piece of paper to me. I really like this. People in the comments, get in the comments. Let me know what you think. Are pitch decks overrated or underrated? We have a yes. Pitch decks are way overrated. Yes, put your name in there too, because I want to give you a shout out. You've been really active in this conversation. Yeah, I agree, but it feels like, pitch decks are like the business plan. I remember growing up, everybody's like, "You need a business plan. Oh, you're gonna start. You better have a business plan."
27-page one. I was like, "Who the hell?"
Yeah, and it has to be long. Like, that was another thing about business.
Yeah.
It has to be long. If it's not long, it's not thorough. You haven't thought of everything. It's like you're supposed to put together a 40-page document, and then you go talk to somebody, and then you hand it to them like, "Let's just talk about like the idea." Like, nobody wants to talk about that.
Yeah.
Yeah, spot on. Pitch decks overrated. We got a question actually around that. Kind of conversely, Christine wants to know, how important is an elevator pitch?
I love this question. And it is one of the most important things you can have for your business. The reason is because you're going to use an elevator pitch more than any other pitch format, any other piece of material you ever make for your business, from networking to non-dilutive pitch opportunities, meeting investors, to, meeting wherever it could possibly be. The whole premise is like, you should talk quick, like be concise enough that you could tell someone you don't know in an elevator before you get out that they know what you do. But 30 to 60 seconds is standard. And I actually have the same kind of 60-second format. We force all of our founders to make it in our programs, all of them. We had hundreds of founders walk away with winning elevator pitches, getting them huge checks. And it's something you use over and over and over again. I use the same one, like, format for years, and it won me a lot of money.
Wow. Is that like a standard, not template, but structure, like a narrative structure that you use?
Yep. Part of our secret sauce.
She's not going to tell us.
I mean, you can Google formats, right? But it's essentially like your story, your facts, your problem, like your solution, like, all that you could Google a format, right? But we have some verbiage and language that's like, this is where to cut it off and when and why.
Yeah. And I love them because you're at a cocktail party. People are receptive to you. People are open. People are imbibing. People like you. And you're like, now, boom. And they say, "Well, what do you do?" Let me tell you, boom. And not over talking it where it's like, okay, 5 minutes
someone's bored. They can't repeat it to someone else in the room. They should be excited when they leave the conversation. The point of an elevator pitch is you purposely leave things out so it incites question and interest.
I like that. And the repeatability is key too. Because now I'm going to go tell my business partner or my spouse partner, whatever, "Oh, I met this person and they do this and it's really cool because this and this." Really? They have to be able to repeat it. Christine's saying, I think the elevator pitch should fit your personality. Yeah,
it's supposed to showcase your energy. It should be excitement for the business. Because if you're not excited about it, why would you expect your audience to be excited about it?
Yeah, dig it. Next one up. Mentors, overrated or underrated?
Underrated.
Underrated. Yeah. You're right. I mean,
I just had mentors that changed my life, my business.
Give me like one example.
I had one who vetted me to their manufacturer in China. I couldn't afford it. I couldn't do 50,000 units a month. They're like, Kat, we'll personally vet you, meaning that if I defaulted on a payment, they'd be personally liable. And I was like, why the heck would you do that for me?
Co-sign for you.
They did. And they said, Kat, someone did it for us. And all we asked is that you pay it forward one day.
Oh my gosh, that gives me chills.
Yep. My first overseas manufacturer.
Wow. I read somewhere, someone said the best gift you can give someone is to believe in them. And I don't think any of us would be here today without someone believing in us, pouring into us. What's the key though to attracting those mentors? Because we're not all
transparency and gratitude.
Yep.
Because I would just, sometimes I wouldn't even ask for it. People had offered, like, you know what, I've been there and you seem like you're going to be coachable and do right by this. So that was a big factor too. It's like willing to be coachable. People will recognize that.
Getting me emotional over here. No, totally. I mean, so many people have poured themselves into me and I'm like, why am I so fortunate to get this person who's up here, who's like a Mount Rushmore type of person in my industry or whatever, to like take an interest in
we all need mentors, like, you know, with anything.
Yeah. And then the gratitude. I mean, because you have to ask yourself, like, what is this person getting out of this? And I think it's they feel validated because now they have all this wisdom and experience bottled up in them.
Yeah.
And like, it's funny because we go home, we talk to our, families and nobody cares. And then, but then we find
you know how hard it is to be a founder.
Yeah. We find a mentee who actually cares and like, who's grateful for it and who's like, that's brilliant. Like, and I'm going to go try it right now. And then I come back and I did it. It worked. And they're like,
well, it's because they could see the change too. They're like, I've already made those mistakes. So it's rewarding to say, like, I'm going to help keep you from doing those same things. So you could go do make this big impact.
Absolutely love it. Absolutely love it. Christine's here saying, I'm a consultant coach of startups, small business owners. We've been told by many we changed the game for them. Thanks for acknowledging us. You're transformative, Christine. You need someone who believes in you. I'm going to the mats for that one. Mentors, underrated. Totally agree. Next one up. Equity accelerators.
So overrated.
What is an equity accelerator?
An accelerator is typically a short period of time. It could be anywhere from 4 to 6 weeks, even 3 months, 8 weeks, whatever it might be. It's a set period of time that ends. Okay. And that accelerator will take a forever chunk of the company. Forever chunk of that company and support you for that set limited period of time.
Why do people do it?
Some of them do need capital. Some of them like the mentors and support, or they're super early stage now. I'm not bashing all of them. There's some good ones, but not all of them are created equal. And we see more founders get hurt by them and regret that decision than saying that it was instrumental and worth it for them.
Yeah, I don't know about that particular thing, but I do know that people try to take partners way early in their idea because they don't have the confidence in themselves and they think they need somebody to hold their hand, and they start holding hands with somebody and walking down the path, and they realize very quickly that they want it way more than the other person wants it, and they're way more driven. They see the problem better, they see the solution better, and they just wanted somebody to hold their hand. You don't need to give somebody equity for that. You can have a mentor, you can have a friend who maybe put sweat equity in, but like you don't need to just say, hey, when you want to be my 50-50 partner in this business because I'm afraid to walk down this path without holding a hand. I agree with you 100%.
Well, there was some like programs that even had equity in the company or predatory terms and they went under. So they had also paid some cash plus given up equity.
Oh my gosh.
And they lost all. It was called New Chip.
They paid for the program?
Yep. And gave up equity and lost everything from them. Mm-hmm.
Wow.
Super predatory.
Okay. Equity accelerators.
But again, not all are created. There's some good ones, just not all are created equal. So you've got to do your due diligence.
Is there a good one that you would like recommend? Or
I'm not going to publicly say one.
Okay.
But we're not an equity-based program. We're strictly fee-based because I'm only going to take equity unless I'm personally investing in you. That's what I believe in.
And fee sounds hard when you're not cash flowing, but long term, like
we're helping them raise, so we're paying for ourselves.
Yeah,
right?
if you give up equity, that means every year you could be either cutting a check of cash, or when the big, the big success day, the windfall happens, a massive number. Yeah, no bueno. All right. Next, do we have one more? Startup attorneys, overrated or underrated?
Underrated.
Really? All right. We're not usually very sympathetic to attorneys on the show. Some of our clients. Shout out to our clients. We love
Keyword
y'all.
is startup.
Okay.
Keyword.
All right. Tell us why.
I had attorneys that charged way too much, didn't understand the startup ecosystem, had no support,
Okay.
and it's that's not the right partner. There are specific attorneys who have expertise in the startup world. Like if you're going to formulate your company, if you have a legal issue with something as a startup, you should not go find your real estate attorney or whoever your uncle down the street.
Your family attorney.
It's got to be someone who knows the startup realm specifically because they've had that experience, they have those connections, they can even share industry insights, what they're seeing. So anything like even startup accountants, that's why I recommend Forecaster because it's startup specific. Attorneys, not all are created equal. So someone startup specific is so crucial.
They sound expensive.
No, that's the point. Startup attorney is cheaper than a regular bigger attorney.
Okay. All right. All right. Well, I'm going to trust you on that one. I'm going to trust you on that.
Experience.
Yeah. All right. I'm going to trust you on that. James saying Accelerator, such a mixed bag. YC was very informative and a great community, but swamped and rigid. An interesting experience. Thanks for the share. Hit that like button. Get in the comments. Kat, I know we're a little over. Thanks for everybody for being here with us. Kat, you want to leave us maybe with just a final thought?
The best advice that I got starting my company was that everything is negotiable. I share that a lot. Preach. I like that one.
Was there a key negotiation or one particular one that stands out to you that maybe that kind of opened your eyes, or you're like, gosh, I'm glad I negotiated that?
I never negotiated my manufacturer to that first. When they sent me a quote, I was like, oh, all right, this is it.
That's the price.
And they were like, what? You're not negotiating that?
They said that over thinking you were going to, they put fluff in that.
Yeah. And so then I learned, I was like, all right, I'm going to get multiple quotes. I'm going to know what the industry standard is and be able to stand my ground and educate myself in that. I never thought to negotiate some of the most basic things you negotiate with investors, you negotiate with advisors, mentors, like it's part of the process.
Is that one of those, like one of the most important, what's the most important skill in this world? Is it negotiation? Is it pitching? Is it like selling? Is it financial acumen? Is it?
I would say, I would argue maybe a couple different things. It's a very deep question, but a combination of like coachability and not empathy, but a way to like build relation. I'm trying to think of the right word. It's like connection, relation based, because that's where we get a lot faster a lot of the time. And that's why you go to a certain, industry or state or place to get support and grow. So I think the combination of like that relationship building and coachability, because you're never going to get anywhere if you can't learn and grow, right? Like that's the point as humans. And I think those two things maybe.
Yeah, sometimes people call that networking, but it seems a little transactional. Building that deeper relationship where people building trust.
Yeah.
I love coachability. You said it. Somebody else posted on LinkedIn yesterday, I think. Coachability over the last 2 years, I've realized that's the number one skill I like to vet for in my staff and team members, is like, because I feel like, okay, as a leader in my business, I've got a lot of the answers. I just need you to be willing to take them and run with them.
Yeah.
Love it. Kat Weaver, Power to Pitch, founder, making dreams come true out here, helping people find their dreams and their purpose and be their greatest self as entrepreneurs. Really awesome having you here.
I appreciate it. So it was a lot of fun.
This was fun.
Thanks for having me.
Yeah, awesome. Thanks everybody for being here. We will see you next